Welcome to this lesson about the Series 65 exam. This lesson is going to be on financial reports and accounting fundamentals, a crucial component of the economic factors and business information section of the Series 65 exam. As a future investment advisor representative, IAR, you need to understand how to read and interpret financial statements, recognize the significance of corporate disclosures, and evaluate the credibility of financial data. This lesson will teach you how to assess a company's financial health using standard accounting principles and regulatory filings. We will cover the three main financial statements and how they are used, the role of auditor disclosures, SEC filings, and annual reports, and basic accounting principles, including audit status and accounting methods. Let's dive into the numbers and make them meaningful for investment analysis. So first, let's talk about financial reports. Publicly traded companies are required to disclose a set of standardized financial statements. These reports help investors evaluate profitability, solvency, and cash flow. So first, we have what's called the income statement. This is also known as a profit and loss statement, or a P&L statement. This report shows a company's revenues, expenses, and profits over a specific period. For example, quarterly, or maybe even just monthly, or annually. So once a year, it might even come out. There are a number of key components to this. We have the revenue, sales, the cost of goods sold, COGS, C-O-G-S, cost of goods sold, it's the acronym, gross profit, operating expenses such as R&D, SG&A, operating income, and net income. So these are all things that are shown on the income statement. So why does this matter? This statement shows how much money a company made or lost. Trends in revenue or profit margins can guide stock analysis. All right, so that's the first thing you need, income statement. The second thing you need is a balance sheet. So this is a snapshot of a company's financial condition at a single point in time. So it's like you're taking a picture, freeze. What is it right now? It lists assets, and the assets equal the liabilities plus the shareholders' equity. And there are three major sections in here. We have the assets, that's the current and both current assets and long-term assets. Current assets are things like your cash, your inventory, and your long-term assets are things like property and equipment. You also need to list your liabilities, both your short-term and your long-term liabilities. Your short-term liabilities, those are things like accounts payable, and long-term liabilities are things like bonds payable. Well, you're not going to pay that for a while down the road, but you still need to keep it in mind. And then finally, we have equity. This is retained earnings, common stock, and additional paid-in capital. So all these things together, those are the major sections of the balance sheet. So why does that matter? This is used to assess liquidity, short-term health, and leverage, which is that long-term solvency. So you're assessing both short-term and long-term, how well a company is doing. Ratios like current ratio and debt to equity are derived from here. Okay, the third statement you're going to talk about is the statement of cash flows. This shows how cash enters and leaves a business over a period of time. It's broken into three different parts. First, we have operating activities. These are day-to-day business expenses. Cash from sales, payments to suppliers, the day-to-day stuff. We also have investing activities. This shows the purchase and sale of long-term assets, such as equipment or other investments. And then finally, we have financing activities. So these are things like loan, equity insurance, and dividends. So why does this matter? So even profitable firms can run into trouble if they don't have enough cash flow. This report helps track that liquidity and solvency over time. So it helps you avoid that sometimes hidden problem of not having enough cash flow. Next, we have auditor disclosures, qualified versus unqualified opinions. So when a company's financials are reviewed by a CPA firm, the auditor will issue one of several types of opinions. So one first is called an unqualified opinion, also known as a clean opinion. This means that the financials are fairly presented according to GAAP. This is the best and most common, so generally accepted accounting practices, GAAP. Then we have a qualified opinion. This means that the financials are mostly accurate, but there's a specific concern or limitation, such as a scope restriction. Then we have what's called an adverse opinion. The financials are not fairly presented. This is rare, but it is a serious red flag if they issue this one. And then we have a disclaimer of opinion. This means that the auditor cannot express an opinion due to insufficient information or independence concerns. So why does this matter? Investors and advisors use the auditor's opinion to judge the credibility of the financials. A qualified or adverse opinion warrants deeper due diligence. So you're going to look a little deeper into a company if they don't get an unqualified opinion. And you might decide not to invest in them at all. Okay, the next one we have are corporate SEC filings. Public companies must file regular reports with the Securities and Exchange Commission, SEC. Some of these key filings include the Form 10-K, which is the annual report with full audited financials. This is much more detailed than the annual report sent to shareholders. So this is the one that's for the SEC. We also have the Form 10-Q, which is the quarterly financial report that's not audited. Then we have the Form 8-K, which reports material events such as a CEO resignation or a merger, some big material event in the company. And then we have the Form S-1, which is used when a company goes public. So why is this relevant to your exam? So you must know which forms correspond to which types of disclosures. So these documents provide timely and transparent data for investment evaluation. So they are an important part of doing your job. All right, the next section are these annual report. These are shareholder-friendly versions of the 10-K. They often include, one, a CEO's letter, a little message from the CEO, kind of just telling the shareholders how things are going, a company's mission or strategy, the highlights of the financial data. So if they have some things that went really well, they might want to highlight those and say, hey, look how great this is. And then other charts and visuals to help the shareholders visualize what it is they're talking about. So while it's not as comprehensive as a 10-K, annual reports offer a narrative about a company performance and future direction. So that's important for the shareholders to feel good about their investments. And so that's why these go out. All right, so let's switch gears a little bit and talk about some accounting fundamentals. So understanding accounting mechanics helps advisors interpret financial reports with a critical eye. So that's something you definitely want to do. That's why you need to listen to this part. So first, I want to talk about audited versus unaudited financial statements. So an audited financial statement is one that's reviewed and verified by an external CPA firm. So a third party goes in and looks at the books. This is required on, say, these annual 10-K filings. That has to be in place. You have to have, they have to be audited. However, we also have unaudited. And so these are internally prepared and they're not independently verified. This is common for 10-Q filings, the quarterly filings, but not the annual filings. So the key difference here is that audited statements carry much more credibility, especially due to the due diligence or legal purposes. So, of course, if something's audited by a third party, you're going to be much more likely to believe it rather than something that just is prepared by the company internally. All right, so we're going to talk now about cash versus accrual accounting. There are two different methods of recording income and expenses. So first, we've got cash accounting. Revenues and expenses are recognized when the cash is received or paid. This is simpler, but it's less accurate for timing. We also then have, on the other hand, accrual accounting. This means that revenues and expenses are recorded when they're earned or incurred, regardless of the cash movement. So this is required under GAAP for public companies. They have to do it this way. This matches the income with the period it was earned, so this also improves the accuracy of the accounting in general. So under accrual accounting, if a company ships goods in December but receives payment in January, the revenue is recorded in December. So why does this matter? Cash-based financials may understate or overstate income during certain periods. Advisors should recognize the limitations of each approach. All right, let's go ahead and recap this lesson. So first, the income statement, balance sheet, and cash flow statement each tell a different part of a company's financial story. Auditor opinions affect the credibility of these statements. Unqualified is best. That means everything is above board. Companies file regular reports with the SEC, including 10-Ks, annual, 10-Qs, quarterly, and even 8-Ks, event-driven. Audited financials are more reliable than unaudited ones. And then understanding cash versus accrual accounting is key to accurately interpreting a company's financial health. All right, so I'm going to go ahead and ask you a series of questions. So first multiple choice, and then a few open answer ones. Test yourself to see if you are ready to move on to the next lesson. All right, so here's the first one. Which financial statement shows a company's revenues and expenses over time? Is it A, balance sheet, B, a cash flow statement, C, an income statement, or D, an annual report? The answer is C, an income statement. Shows revenue and expenses over time. Which of the following is not found on a balance sheet? A, total liabilities, B, net income, C, total assets, D, shareholders' equity. In this case, B, net income, is not found on a balance sheet. All right. Next, we have, what does a qualified auditor opinion indicate if it's qualified? A, the financial statements are completely inaccurate. B, the auditor was unable to complete the audit. C, the financials are mostly accurate, but with specific concerns. Or D, the company is in bankruptcy. In this case, the answer is C. The financials are mostly accurate, but there are a few specific concerns. Which SEC filing contains a company's annual audited financial statements? Is it A, Form 10-Q, B, Form 8-K, C, Form S-1, or D, Form 10-K? This one is Form 10-K that includes the company's audited annual financial statements. Which section of the cash flow statement includes cash received from customers and payments to suppliers? Is it A, investing activities, B, operating activities, C, financing activities, or D, equity activities? In this case, the answer is B, operating activities. Which of the following accounting methods records revenue when it is earned, not when the cash is received? Is it A, modified accrual, B, deferred recognition, C, cash accounting, or D, accrual accounting? The correct answer is D, accrual accounting. Which of the following is true about unaudited financial statements? A, they are only used by private companies. B, they are reviewed by the SEC before release. C, they lack independent verification. Or D, they cannot be used by investors. The correct answer is C. So they lack independent verification. So you might see them for like quarterly reports, but not for the big annual financial reports. What does the auditor's unqualified opinion indicate? A, that the auditor has serious reservations. B, that the financial statements are fairly presented. C, that the audit was not completed. Or D, that fraud was discovered. So an unqualified opinion is actually a good thing. So the answer is B, the statements are fairly presented. That's exactly what you want. Which document would report a sudden resignation of a company's CFO? Would that be 10-K, B 10-Q, C 8-K, or D S-1? So in this case, it's C. So if there's a big event that happens with the company, like the resignation of a major operator, then yes, you would need to file an 8-K with the SEC. What is the main purpose of the statement of cash flows? Is it A, to measure profitability, B, to show changes in assets and liabilities, C, to track how cash is generated and used, or D, to calculate shareholder equity? The correct answer is C, to track how cash is generated and used, to make sure that you have a sufficient cash flow, because that can sometimes fly under the radar. All right, now we're going to go to some of these open-ended questions. So I'll give you a sample response, but your response doesn't exactly have to match my response. All right, so the first is, why is the auditor's opinion important when evaluating financial statements? Think of that a little bit. Formulate an answer, and then see how close it is to what I say. The auditor's opinion provides an independent assessment of the accuracy and reliability of a company's financials. An unqualified opinion increases confidence, while a qualified or adverse opinion signals potential issues. So that can make investors less likely to invest in that company. All right, how did you do? You doing well? Let's move on to the next one. How do cash and accrual accounting differ, and how they represent company performance? Think about that for a moment and provide a response. Cash accounting only records transaction when cash changes hands, while accrual accounting records revenue and expenses when they are earned or incurred. Accrual gives a more accurate picture of financial health, and in some reports, it's actually required. You can't do cash accounting, you have to do accrual accounting. Who is primarily responsible for implementing monetary policy in the United States? Is it A, the Department of Commerce, B, the Federal Reserve, C, Congress, or D, the Internal Revenue Service? In this case, it's B, the Federal Reserve. They are responsible for all of those things. Which yield curve shape most often signals investor expectations of strong economic growth? Is it A, inverted, B, flat, C, normal or upward sloping, or D, concave? In this case, it's C, normal or upward sloping. That is what you'll see if the economy is going great. Which policy tool is used to manage short-term interest rates directly? Is it A, capital gains taxes, B, open market operations, C, treasury bond issuance, or D, import tariffs? In this case, the answer is B, open market operations. Which global factor most directly affects an investor that's holding foreign assets? Is it A, U.S. monetary policy, B, currency exchange rates, C, the federal budget, or D, unemployment rates? The answer is B. It's those currency exchange rates. So if you hold those foreign assets, the currency exchange rate has a larger impact on your investment. Which phase of the business cycle is typically associated with rising interest rates and inflation concerns? Is it A, expansion, B, trough, C, contraction, or D, recession? In this case, the answer is A. That's when we're worried about rising interest rates and inflation. Which of the following is a tool of monetary policy? A, corporate tax rates, B, government spending on infrastructure, C, open market relations, or D, trade tariffs? So monetary policy, open market relations is the only one that is a tool of monetary policy. What is the primary purpose of the Series 65 exam? A, to become a certified financial planner, B, to work as a broker-dealer, C, to be an investment advisor representative, or D, to sell variable annuities? The answer is C, to become an investment advisor representative. How many questions must be answered correctly to pass the Series 65 exam? Is it A, 91, B, 94, C, 100, or D, 110? The correct answer is B. You need to get 94 out of the 130 questions correct. And if you do that, then you pass the test and you can move on. Which of the following is the most effective way to address weak areas in your study? A, skip them and focus on the strong areas. B, increase time spent reviewing those topics. C, avoid practice exams. Or D, study only on weekends. In this case, it's B. You want to increase the time spent reviewing those topics. If you can make your weak spots into your strong spots, then you should be okay when you take the exam. My next question is, which organization develops the Series 65 exam? A, FINRA, B, the SEC, C, the NASAA, or D, the SIPC? Take a second to think about that. So in this case, it's C. It's not actually FINRA. It's the NASAA. Which topic has the greatest weight on the Series 65 exam? Is it A, economic factors, B, investment vehicles, C, laws and regulations, or D, client recommendations and strategies? In this case, it's D. Client recommendations and strategies are going to be the largest part on there. Which of the following is not typically included in the Series 65 exam study materials? A, practice exams, B, market timing signals, C, flashcards, or D, video lectures? The answer is B, market timing signals. All those other things you will usually see. What is one reason to take full-length practice exams? A, to memorize answers, B, to avoid using a study guide, C, to build test endurance and identify weak areas, or D, to learn regulatory definitions only? So here the correct answer is C, to build test endurance and identify weak areas so that you can work on them in the future. And finally, what is the significance of the cash flow statement for investment advisors? Think about this one for a minute. The cash flow statement shows whether a company is generating enough cash to support operations, invest, and pay shareholders. Strong operating cash flow can be a positive signal for long-term sustainability. And of course, the opposite is also true. All right, how did you do? If you're feeling good and you got most of those questions right, you can move on to the next lesson. If not, you might want to review a bit before going on. Our next lesson is going to be analytical methods, time value of money, and descriptive statistics. And that is all for our lesson for today. Thank you very much for listening.